For more now on Europe, we are joined by Jim Swanson from MFS. He's the chief investment strategist there, and the portfolio manager. And his diversified income fund used debt and equity to beat 94% of its peers over the past 5 years. So he has done quite a good job, and that's why we are happy to have him on the program. Jim, let me ask you first about your take on Europe. I mean, it's been a focal point for this market, even if we have a day when we like to look at a couple of U.S. Data points. It's really the situation in Europe, no matter how sick of it we are, that drives the swings in these indexes.
You're right. We are sick of it, too, but it is the #1 sticking point. It's the block that's preventing anyone from really looking at corporate earnings and corporate cash flow, which up until this day are still doing real well. But we need to see those banks not have a run. We need to know those banks are going to hold through the possible restructuring or defaults. And that's what everyone's waiting for. We had some good news on that today, but there's no major solution in the works yet.
Why aren't people more optimistic on the German vote passed with flying colors, really? I mean, Merkel didn't need any of her opposition there. And it seems to me that if you leverage the EFSF up right, you could do some pretty serious, whatever the opposite of damage is, right? I mean, it could really help. Why do you think people aren't more optimistic?
It could help, but there's still some structural reasons why a lot of people think a leveraging up of the Stability Fund is not in the works. There's some constitutional, some legal issues. I agree. If they can lever the funds that are in the Stability Fund up, like we kind of saw with the PPIP program, which didn't really get off the ground, but in 2008 we had something very similar. We leveraged up a facility with the Fed and the Treasury Department to buy up distressed assets, and just the fact they put that together gave confidence to the markets. Well, I think if you can leverage up these funds, I think you can get enough heft and enough firepower to stem the tide of deposits that are leaving, you know.
Jim, you feel confident about that? Because I bring up Wilbur Ross, we talked to earlier here on Bloomberg, and he said that this bailout program doesn't even come close to the necessary size. He says it's got to be, you know, in trillions, not billions, that we're not even close here. I mean, so don't we need to see a much bigger fund here? And don't we need to already just see Greece take a haircut on their debt? And we got to move on. We got to look at Spain. We got to look at Italy.
Yeah, well, you're absolutely right. You have to go on now to Spain and Italy, and those are big numbers. And if you look at the French banks, for example, and the capital of those banks exposed, for example, just to Italy, but you have time with Italy, and Italy and Spain have shown some proclivity to, you know, cutting back their expenditures. So there is some hope that they'll do that fiscally. But I agree, the amount of money in the system now, in the Stability Fund, isn't big enough.
All right.
That's right.
So let's talk about your performance, because you've got a great track record, not just over the last year, but over the last 5 years. So talk to us about where you're investing at this point.
Well, right now, underweight U.S. stocks just because of the European, we just talked about, because of this European bank crisis, slightly underweight U.S. stocks. But interestingly enough, I've got bond sleeves in this fund and overweight high yield. High yield credit market has already priced in a U.S. recession. Point number one, I don't think we're going to have a recession here. We're stumbling pretty close to the borderline, but we don't get a recession. And that market's already priced it in. So I think that's a place investors can feel that, hey, they're getting compensated for that kind of risk.
And you like high yield debt right now. You favor it over U.S. Treasuries. Obviously, if you don't think we're going to have a recession, that makes sense.
Yeah, for sure. I mean, the Treasury market doesn't appeal to me. The 10-year benchmark at around 2%. When I'm looking at inflation numbers, 2.5, 3, I'm losing value that way. I'm underweight there. And I'd rather be in these credit instruments that are backed by companies that I can see real cash flow. I can see their balance sheets are better than they were when we went into the last recession. And there's a lot of cash on hands, and the credit markets are functioning. So I think the high yield market, it's not going to come back right away, but it's in fundamentally good shape, and the yields are expressive of a worst case scenario, which I don't think will happen.
Jim, what about stocks? I mean, you're underweight U.S. stocks, but do you buy on the dips? It seems like everybody down here has been selling on the bounces.
Yeah, they have been selling on the bounces. You're absolutely right. I am a believer that there's no way to call a bottom. This is a very negative market. It's a very in and out type of market. It's not the kind of thing I'm comfortable with. I'm a long-term investor. I do think if you start putting new money to work over the next 6 months in equities, particularly dividend-paying stocks, technology type stocks, you're going to do real well over the long run because it's these companies that have the cash flow and the ability to grow their dividend streams.
Jim, I'm looking at my notes and you say software has become like a utility. I find that interesting. I mean, explain that. And then where in software are you finding the opportunities?
Well, there are definitely opportunities in Techland galore. One of the things I would note that the average PE in the IT sector, which by the way is the biggest sector of the S&P now, bigger in market cap terms than the banks were 3 years ago. So this market, we actually make this stuff and sell it to other people. Software is a big part of the tech sector. A lot of these companies are trading below market multiples. In other words, the forward market multiple is pretty low anyway, at least by historic standards. And the tech sector is trading below regular companies that don't make these kind of products, and the software side of it has to be replenished. We have the oldest software base right now in the U.S. that we've ever seen. At some point, these companies have to replenish that, and they're starting to do that. We're starting to see that pick up.
Any insight, Jim, as to why tech stocks have been getting crushed today? Is it all about AMD's cut yesterday?
It might be. I don't know exactly what's going on there. It seems like there's some big sellers behind the screen, and people are upset. But, you know, these companies in general, painting this whole sector with a broad brush, trade on a very low PE from historic context point of view. They have triple the EBIT margins they had 10 years ago, double the cash flow margins, and yet the market's ignoring. There are 3 product revolutions going on here. It's the second most leveraged to foreign sales of any of the sectors of the S&P, and they're awash in cash. They don't have any debt, so they're structurally, I think, actually becoming a new defensive in a way.
Got it. All right. Hey, Jim, thanks so much for joining us. Jim Swanson there from MFS.